Hey everyone, welcome back to Corporate Decoder. Today we're diving into Flagstar Financial's annual report, and let me tell you, it's a bit of a roller coaster. Imagine inheriting a fixer-upper, only to discover the foundation is also a little shaky. That's kind of what happened here. Brace yourselves, folks, it's going to be a bumpy but hopefully insightful ride. Flagstar Financial, a major player in banking, has just released its 10K, a yearly report card of sorts, and it reveals a company in the middle of a huge transformation. From a near-death experience with deposit runs, a reverse stock split, a name change, and a complete management overhaul, it's been a year. The company essentially had to do a complete rebrand and restructure to try to win back investor confidence. So buckle up as we decode what all of this means. First, let's get the legalities out of the way. This report, like all corporate reports, contains forward-looking statements, basically educated guesses about the future. The company warns us that a whole host of factors could make these guesses wrong, from economic conditions to changes in interest rates, or from climate change to geopolitical instability. So keep in mind that everything we're about to discuss is subject to change. Now let's dive into the core of the report, Flagstar's performance for the year. To put it gently, 2024 wasn't their best year. They reported a whopping net loss of $1.1 billion. That's a huge difference compared to the $79 million loss the previous year. You could say they definitely didn't have a great 2024. One of the big reasons for this loss, credit risk. The company had to set aside a massive $1.1 billion for potential loan losses, bringing their total allowance to $1.2 billion. This means they're anticipating that a significant chunk of their loans might not get paid back. This is largely due to problems in the office and multifamily real estate sectors. It is important to note the Community Reinvestment Act requires that these institutions meet the credit needs of the communities. So the company has committed to provide $28.0 billion in loans, investments, and other financial support to communities. However, they changed their intent as a result of the sale of their third-party mortgage origination and servicing business. And speaking of multifamily loans, Flagstar has a significant concentration of these loans in New York City, about half of the loans. Changes to rent regulations in New York could make it harder for landlords to increase rents, impacting their ability to repay those loans. This is something investors are definitely keeping an eye on. Flagstar also went through some significant rebranding in 2024. They changed their name from New York Community Bank to Flagstar Financial, aiming to align with their new strategy as a full-service regional bank. The company's stock ticker symbol also changed from NYCB to FLG on the New York Stock Exchange. Think of it as the corporate equivalent of a fresh haircut and a new suit. Beyond the name, Flagstar also brought in a whole new team. Several new risk management experts have joined the company, along with new executive management team and a brand new board of directors. We're talking a completely new executive management team, including the Chief Executive Officer, Chief Financial Officer, President of Commercial and Private Banking, President of Commercial Real Estate Banking, Chief Credit Officer, General Counsel and Chief of Staff, Chief Risk Officer, Chief Enterprise Compliance Officer, and the Chief Audit Officer. Most of the current board members were also newly appointed during 2024. It's like a corporate rescue squad swooped in to try and turn things around. You can find a lot more info at flagstar.com, including all their SEC filings. It is important to note that all information in the website is not incorporated by reference into this report. Like any financial institution, Flagstar is heavily regulated. The report goes into detail about all the rules and regulations they have to follow, including capital requirements, consumer protection laws, and anti-money laundering rules. Staying on top of all these regulations is a constant challenge. They have the regulatory agency, the FDIC, FRB, and the OCC watching. Reading through the report's risk factors section paints a clear picture. Flagstar is facing a lot of uncertainties. One big risk is interest rates. If interest rates change, it could hurt their profits and the value of their assets. They're also worried about credit risk, cybersecurity incidents, and their ability to keep up with technological changes. Capital requirements are also big, as Basel III requires that the company and bank maintain certain capital. The company mentions that they will most likely need approval from the OCC to pay dividends during 2025. One of the things that makes Flagstar's situation tricky is the degree of estimation required for its financial statements, and especially the allowance for credit losses. This relies on analytical models that might not accurately predict future conditions. This is what the company has to use, but it is very uncertain. Liquidity, or having enough cash on hand, is also a major concern. If too many depositors withdraw their money at once, it could create a serious problem. This is especially true because not all of their deposits are insured by the FDIC. The company has to ensure the customer data is protected, and they have to work with regulations such as the Cybersecurity Information Sharing Act, the CISA. Now let's talk about the lawsuits. Flagstar and some of its officers and directors are facing several lawsuits, including shareholder class actions and derivative suits. These suits allege things like breach of fiduciary duty and violations of securities laws. The outcome of these legal battles is uncertain and could cost the company a lot of money. Here is where we see the problems of recent cybersecurity events and may be vulnerable to security breaches. These incidents have resulted in, and could result in, additional expenses, exposure to civil litigation, increased regulatory scrutiny, losses, and a loss of customers, any of which could adversely impact our financial condition, results of operations, and the market price of our stock. We need to make sure we are compliant with these new technology changes. The company discusses the risk of their stress testing not working out. Essentially, if their models fail, it will have a negative impact on their business. They also mention CECL, or the current expected credit loss model. The process of determining whether or not the allowance is sufficient to cover potential credit losses may result in greater volatility, depending on the various assumptions and factors used in the model. As of January 2024, the company has a community pledge agreement with the National Community Reinvestment Coalition that they may not be able to follow through with due to the sale of their third-party mortgage origination and servicing businesses. The potential failure to meet this agreement could affect our operations and reputation. A final risk they mentioned is the failure to keep up with technological changes in order to attract new loans and deposits, and in turn, affects their financial condition and results of operations. As part of the enhanced stress testing prudential standards, Category IV banks are not required to calculate forward-looking projections of capital under scenarios provided by the board. The board of directors is required to approve the company's capital plan, which could limit the payment of dividends. As a financial institution, we are subject to a number of risks. The company has what is called a risk governance framework, which is designed to manage the risks to which we are subject, as well as any losses stemming from such risks. But if the framework is not effective, the company might incur losses in the future. A large tax benefit is the government's low-income housing tax credit. The effective tax rate may decrease if the housing doesn't meet the standards, which may affect our earnings. There are also federal restrictions which state that the Federal Change in Bank Control Act, CIBCA, a notice must be submitted to the FRB if any person seeks to acquire 10% or more of the company's shares of outstanding common stock, unless the FRB has found that the acquisition will not result in a change in control of the company. A reminder to the board of directors: dividends must be approved by the OCC if the dividends it declares exceed the net profit for that year combined with the retained net profits for the preceding 2 years. Due to large exposure to commercial real estate lending, the management must be extra attentive that their loans meet best practices. The properties and facilities that house bank operations are also examined for environmental risks with a two-pronged approach. This approach assists us in mitigating environmental risk by enabling us to identify and address potential issues, including by avoiding taking ownership or control of contaminated properties. Let's wrap this up with Flagstar's regulatory capital position. Each of the bank's capital ratios exceeded those required for an institution to be considered well capitalized. The bank is required to submit to the FDIC full resolution plans every 3 years and interim targeted information between full resolution plan submissions. If the FDIC finds an insured depository institution's resolution plan to be not credible, it could subject the insured depository institution to an enforcement action. Now, after taking a look at these numbers, there are definite strengths and weaknesses. Their capital ratios are exceeding expectations, but there is also the problem of higher interest rates putting pressure on debtors' ability to pay. Also, let's not forget the regulatory overhaul they had to put in because it is a Category IV banking organization. Despite the rocky year and potential issues in 2024, Flagstar seems determined to turn things around, as seen by all the decisive actions to build capital and reinforce their balance sheet. So, what's the verdict? Flagstar is a company in transition. It is recovering, yes, but it is important to watch closely how these strategies play out in the coming years. Thanks for decoding with me today. If you found this analysis helpful, don't forget to like, subscribe, and share your thoughts in the comments below. What do you think Flagstar's chances are? Let's discuss.